The host of Wall Street Week, David Westin, joining us as he does every day at this time. Your show kicks off in a little more than an hour, but you already had a chance to sit down with Larry Summers, the former Treasury Secretary. And I know there's been a lot of discussion here about the labor market report we got this morning and how that's going to feed into what the Fed does when it meets in about a week and a half.
And Larry has some strong views on it, as you would expect. He typically has strong views on things, and he thinks those jobs numbers are very strong, and he thinks that actually should put 50 basis points on the table for the Fed. He says that they may need to go farther than what they think they do. But we started off the discussion really about jobs, as you suggest, Romaine, and really how strong he thought those numbers were and why they matter.
I think these are strong numbers in toto. 339,000 jobs is a lot. There were upward revisions for the previous 2 months. We've always known that the monthly unemployment rate is a very noisy series. That's especially true in May when you got all the seasonal adjustments going on with respect to the kids who are leaving school and looking for summer jobs. So I think you have to read this report as strong. I think the forecasting community's got to do a little soul searching. They've been low on this report for 14 months in a row. That has got to suggest that there's something about the underlying strength of the economy that they're missing. Or another way to put it is that they are exaggerating the impact and efficacy of monetary policy in slowing the economy down. So I read these as a strong report, and I think the general tendency of the data has been very much towards saying that the economy, at least for this while, has a fair amount of robustness in it. You know, the whole idea was supposed to be that in many quarters that vacancies were falling fast. Well, vacancies rose by 300,000 plus in the numbers last month, according to yesterday's numbers. The quit rate still remains high. So I think we've still got a tight, hot labor market, and we've still got many sectors where we've got tight product markets as well. Firms are near capacity. You know, I've flown a fair amount in the last month, and every single flight is full. And when you've got that kind of capacity pressure, it suggests a very real chance of persistence in inflation.
So, Larry, I was going to ask you specifically, where are we getting it wrong? You suggested maybe it's we're overestimating the effects of the monetary tightening. But let me ask you a slightly different question. Should we be as concerned about the tight labor market as a lot of people are? Because, as you know, we have a paper out, for example, from Ben Bernanke and from Olivia Blanchard saying, you know what, labor tightness was not really that big of a cause of the inflation to begin with. There is an issue now that it's sticky, but in fact, it isn't as big a factor. Should we not be as concerned about it as we have been?
I don't think that's the right reading of the Bernanke-Blanchard paper. If you look carefully at what that paper shows, it shows that there were both supply and demand elements in the initial inflation. There were things coming from bottlenecks and just strong demand. But then they also say that the bottlenecks were substantially caused by demand. So I don't see anything in their analysis that disputes the view that A, it was big surging demand, whether through bottlenecks or tight labor markets, that caused us to have significant inflation, and B, that there's been a bunch of fluctuation in the transitory factors, with the transitory inflation going up and then the transitory inflation going back down, but the underlying inflation now running in the 4.5–5% range. And they say that they don't really highlight the conclusion, but they acknowledge that if you want to get inflation down from that 4.5 to 5% range, you're going to have to do things that will have as a side effect a much looser labor market. So I have to say, while I've got great respect for Ben and for Olivier, I do not think that changes what I thought was becoming the mainstream analysis of inflation, the analysis that was offered by those of us who forecast it, that when you have a big surge in demand, inflation goes up, and then you have to have some slack in the economy for inflation to go down. And I think their more academic treatment of what's wage market and what's product market is interesting, but does not change the fundamental policy story. And I'd have to say, if you go back and you look at Ben Bernanke's comments during 2021 and 2022, I guess he was using the same modes of analysis he's using now, and he very much underestimated inflation and was really quite confident that it was going to be transitory. So I prefer the sort of mainstream analysis running through the overall level of demand, and then recognizing that the transient picture from month to month is going to be governed by some transitory factors.